Are you ready to learn the truth about the current market meltdown? Most investors have no idea what's already happening. They haven't even looked beneath the surface during this market meltdown to realize the huge rotation that is taking place. Complete change in the investment landscape based on the arrival of inflation. And this is going to completely change the dynamics that have existed for investors. Over the last decade, pretty much everything that worked while the Fed was inflating this bubble is not going to work as the air comes out of it. And the air is going to come out of it. Despite whatever efforts the Fed may pursue to prevent that, I think they've already picked this bubble. And there's really no way to prevent it from deflating. So, stay tuned because we're going to uncover everything you need to know about this market meltdown and the huge rotation that's taking place. So, to start off, let's talk about inflation, the first component of the inflation equation. It's obvious that we have a serious inflation problem. We've had an inflation problem for more than 10 years. But because the inflation was driving up asset prices, neither the Fed nor investors were concerned when it first appeared instead of retail prices. Consumer prices did increase, but not much enough to raise concerns, especially given that the government was able to mask the true rate of price growth with the CPI, which isn't particularly effective. I believe that by intentionally understanding how much prices are rising, it appropriately reflects what is happening in prices. Therefore, the Fed had to cover to continue inflating under the pretense of quantitative easing, stimulus, and 0% interest rates because the government could pretend that inflation was below 2%. However, the money went predominantly into financial assets. However, it also contributed to a historic rise in U.S. trade deficits. In fact, we learned that the $101 billion trade deficit for December set a new high. For the first time, we had a trade deficit of more than $100 billion in that particular month. These are trading products for merchandise. Additionally, our annual goods trade deficit exceeded $1 trillion. Although that deficit is not unheard of, no country has ever previously accomplished anything so terrible. Even though we experienced a 7% increase in consumer prices, according to how the government measures inflation, some of that served to restrain inflation. If our trading partners had not pushed $1 trillion worth of goods onto our market, just think how much higher consumer prices would have risen. How did we pay for everything then? We did, in fact, print money, and we trade the commodities that the rest of the world made for the money we printed. Additionally, a large portion of the money spent by Americans was simply given to them by the government in the form of stimulus payments or other bailout funds. And from where did that originate? Well, it was printed by the federal government, and in 2020 we implemented the worst conceivable mix of monetary and fiscal policies. When the pandemic first started in March of 2020, the government and the Fed conspired for the worst monetary and fiscal policy probably ever in the history of the United States because the economy was shutting down due to COVID, and to government restrictions as a result of COVID. Instead of doing the right thing and reducing the money supply along with the economy so that the demand would decrease along with supply, the government mailed replacement checks for everyone's paychecks as millions of Americans were abandoning their places of employment. The important thing is that you must be working hard and contributing to the creation of things and services in order to earn a paycheck. You can now enjoy some of the products and services that you help create. However, you need to consume less when you're not working. But the government didn't want that because it would have resulted in more severe recession. Therefore, the government distributed money to everyone to purchase goods and services that they were not manufacturing. And it should not have come as a surprise that we are experiencing severe shortages. I mean, it's quite clear what happens when you don't create. A scarcity results from your lack of supplies. But because of the government and the Federal Reserve, we had so much more demand. And we haven't even started to fully experience all the effects of that inflation. I believe that the inflation we saw in 2021, a major portion of that was primarily the delayed effect of inflation that was generated before 2020. I don't even believe we've caught up to that inflation yet, which is one of the reasons why we are headed considerably higher, and that inflation wasn't only permanent, but will also be much higher than it was during the alleged transitionary period. Naturally, I was one of the few people who believed that the Federal Reserve when they said the inflation we were expecting was only temporary. When I initially claimed that the Fed was lying, I asserted that inflation was only temporary because the subprime market had been controlled. The Fed actually misled us in telling us that. When the subprime market collapsed in 2007, the Fed reassured us that there wouldn't be a problem because the harm was limited to this particular subset of the mortgage market and wouldn't have an impact on the economy or the housing market as a whole. And of course, we ended up with the 2008 financial crisis. The Fed has been trying to placate the markets by pretending to be afraid of what was about to happen, but in reality, it is an aggressive tightening that is likely to take care of the worst inflation in 40 years. Powell is showing that in order to fight this inflation, the Fed is now attempting to do something about it by throwing gasoline on it. But this is not enough to keep up with the market. The CPI is different from the one used 40 years ago, so it can't be compared to the one we are using now. Paul Volcker brought interest rates up to 20% in 1980, creating a powerful incentive to hold on to US dollars and save money. This led to a dramatic increase in inflation, with yields on 30-year bonds reaching up to 14%. If inflation continues to accelerate, real interest rates fall, even as the Fed is slightly raising nominal interest rates, making the inflation problem worse. The biggest problem of the Fed is that they are able to justify their artificially low interest rates and quantitative easing despite the 3% inflation rate. This is due to the immense debt bubble in the US, which has prevented them from allowing interest rates to go to a natural level. If interest rates were allowed to normalize, we would have a far worse financial crisis, as the private sector would have difficulty servicing its debts and the US government would be forced to default on its national debt. The Fed is stuck in a difficult situation, and the bad choice is to fight inflation. The most important details of the phrases Fed, interest rates, NASDAQ, and worst choice are that the Fed is going to provide cheap money, but it's not enough to sustain the bubble. The NASDAQ is down about 14%, S&P is up 9%, foreign markets, and people are piling into stocks as they liquidate overpriced assets. This is making it difficult for investors to get out of overpriced US stocks and trade on a dream that has high prices. Inflation is a major issue for Americans, as it can destroy their cash and lead to the inability to get into bonds and make a huge loss if they want to sell prior to maturity. When investors get out of overpriced US stocks, they can either get into underpriced foreign stocks or get into better value companies that make money right now. However, the US dollar is about to collapse, leading to inflation, which will drive the cost of living up so much that Americans will be spending a lot of their disposable income on basic necessities, leaving them without money left over for discretionary spending. Descriptive spending is the means that people earn a living in part of the economy that benefits from the spending, leading to unemployment and an increase in inflation. This could have a similar effect to the 1970s, when inflation was at its worst and the economy was weak. Unfortunately, it is unstable to put a stop to the stagflation problem, like it did in 1980, due to the country's inability to raise interest rates. Thank you for watching. As we come to the end of this video, let's recap on some important points. Did you know that there was a time when our nation was a wealthy creditor nation, with trade surpluses and relatively small debt relative to GDP? Unfortunately, that's not the case anymore. Today, we are faced with a completely different and catastrophic situation. The current economic climate may lead to an inflationary depression or even hyperinflation. That's why it's crucial to stagflation-proof your portfolio. One way to do this is by investing in good dividend-paying foreign equities. While this shouldn't be the bulk of your portfolio, it's definitely a blueprint worth following. So, as you navigate these uncertain times, remember to keep these strategies in mind. Thank you for tuning in, and we'll see you in the next video.